can that have a ripple effect? Okay, I think we are live now. Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. And like I said, that the Talking Point today is squarely what's happening to equity markets worldwide. From taxes, the possibility of taxes being raised in the US, the way the 10-year yield in the DXY have moved and the ripple effect on EMs, if at all. And in EM specifically as well, the current talking points, as well as the rising cases in India, and what do they mean, if not now, then if the numbers were to move up. Vaibhav Sanghavi of Avendus Johnson right now to talk about all of that. Vaibhav, good having you. Thanks for joining in. And from the place that you're perched in, it'll be really nice of you to give us a sense of how does India compare versus the rest of the EM pack, as well as how do you guys as FIIs or CAT3 AIFs look at India vis-a-vis the other options available. But can I first start off with the big talking point of yesterday or last night, Vaibhav, which is the possibility of rising of higher taxes in the US and what it could mean for equity markets there and the ripple effects across rest of the world, if at all.
No, of course, Neeraj. I think what we have seen yesterday in terms of the announcement on the capital gains tax, possible capital gains tax, we've seen markets there kind of reacting. And if you also have seen that the global volatility, VIX, which is the volatility index, kind of moved from about 16 and a half to 18 and a half. So which means that there can be some amount of degrossing which may happen probably because of this event. Because people would be starting to look and calculate their IRRs on their investments freshly. Now, how does it kind of pan out in terms of DMs versus EMs? I think we'll have to wait, for some more clarity in terms of the rules, announcements, and subsequently we will have to, watch for that. So we'll probably wait till then. But in any case, I think good amount of movement is happening, right, as rightly mentioned by you, in terms of US Treasuries, which has from a high of about 1.76 is now close to about 1.5355. So that is something which has given a good decent move. Apart from the DXY, which kind of on a high of about 93 half, is now close to about 91. So good amount of movement happening in more good important variables which can affect the market.
So Vaibhav, my question is, a lot of a fair degree of people say that the hike in capital gains taxes is a known factor. It was mentioned by the Biden administration in the run-up to the elections as well. So when they got elected in December or January, when they took office, it was known that the taxes would be raised and therefore they will not really scuttle the market too much. Do you believe that could be the case, or do you believe because of taking advantage of the gains that might be there and therefore at a lower tax, there might be some pre-selling that could happen which could take markets lower? I mean, I don't know how closely you have an opinion or how strong an opinion you have on the intricacies of the US, but do you think this is a big problem, or do you think this will get digested easily in a day or two?
No, my sense is basically this will get digested probably in few days. But there is always this case, right, that when the announcement is made, you may see an immediate reaction onto the markets. So, but the underlying fact which is there is, yes, of course, tax is a little irritant, but the economy, the way it is growing, especially in US and the developed markets, I think, the investors would be more enthused with that rather than a small incremental tax number. Of course, it hurts, but at the end of it, I think they would be focused on the economic recovery and the earnings recovery.
Actually, juxtapose EMs versus, say, a market like US currently, right? I mean, vaccinated or on the best case of vaccination in the large countries, so to say, the US, that is. Some of the others like UK, etc., have done okay on the vaccination front too. And compare that to, say, some of the emerging markets, including India. Does it make the case that much less appealing for global money to come into EMs vis-a-vis DMs? And therefore, are we likely to see that for the next 3 to 6 odd months, until this issue settles down, if it does, that money will not chase India or Brazil for that matter?
No, of course, I think, Neeraj, that is a very important point, because at this point in time, if you're looking at growth prospects, economy coming back to business as usual, The first in line is basically the developed markets, especially US, which have exceeded the vaccination in excess of 50%, and we have seen dramatic drop in terms of the infections as well. I think European countries, few of the European countries' timelines is something which we may see going forward, uh, in terms of lockdowns getting out and coming back to and or opening up the economy. So my sense is basically as an investor, if I'm sitting outside looking at global markets, my first port of call or opportunity would at this point in time would be DMs, which is developed markets, and precisely for those reasons, we may see the flows kind of moderate as compared to last year when we saw flows coming at a very rapid pace and one of the record flows in India and emerging markets as well. Because the whole underlying thesis of dollar index getting weaker, emerging markets going to bounce back in terms of their economies and the earnings. I think now the narrative is kind of changing a bit, and preference on the developed markets is there from a global investor standpoint. Of course, if there is a huge relative underperformance on the EMs, then you might see incremental den money coming to EMs. But my sense is basically the first port of call at this point in time would be DMs.
Okay, DMs you mean?
Developed markets.
Got it. Okay, sorry, I misheard. Okay,
Developed markets is emerging
Vaibhav.
markets. Sorry.
Yeah. Oh, no, completely fine. Vaibhav, just a follow up on that. Where does India stand now? I mean, and most people again say that the markets will look through these rising cases because the market is a forward looking animal and the market will look ahead that there is vaccinations. It's opening up from May, and even if vaccines may not be available in the interim period right now in the full gusto, they will be at some point of time in the next 1 to 2 months, and therefore India will vaccinate fairly rapidly. My question to you is, in that interim period that the cases are rising today, the latest numbers are at 3.32 lakhs. At what point does it start worrying the market? Or do you reckon the markets will not be worried irrespective of the cases moving up?
No, of course the markets are worried. No, I mean, I would not say that they are not worried. They are worried that because of the rising cases, ultimately you will see increased lockdowns. We started from Maharashtra, and now it is spreading to other states and cities as well. And if that kind of happens, last time it was very clear when there was a central lockdown, everything went into lockdown at one point in time, and the trade was an opening of lockdown. At this point in time, as we are looking at things, things are not exactly under control, and we may see these cases kind of remain elevated for some period of time till the cases kind of plateau. And you've seen extensive lockdown already. Is when markets would be then looking for an potential recovery trade from there onwards, right? So in that period, I think 1 or 2 months, the uncertainty would be there. And my sense is basically, as a fund, we are risk averse fund, so we generally would probably tend to go into cash, not kind of be adventurous at these kind of points. And once things kind of situation stabilizes, is when we will come back, into the market again. My sense is again that it is just only a matter of couple of months when the vaccination kind of picks up, newer vaccines kind of come into force, including Sputnik, which is expected to happen by May end. So it's an uncertain period for 2 to 3 months.
Do you reckon this uncertainty will be accompanied by a corrective move? Do you expect that the markets will be lower? Now, again, Vaibhav, your predictions right now could go wrong because things could change at the margin on a number of fronts. As things stand right now, do you believe that there is a higher probability that we'll be lower than the 14,200 odd mark that we are right now? Say a month from now or
Of course,
thereabouts, or next 2 months?
the probability is of course there to trade below 14,200. But as you rightly mentioned, Neeraj, it is pretty fluid situation, right? So I would rather say that the uncertainty, the whipsaw, the volatility would be very elevated, at least for the next
Got it.
1.5, 2 months, where news flow will kind of keep on driving the markets, whether it is positive or negative. But at this point in time, as things are looking, it may be marginal negative, at least in the immediate short term.
So yeah, so the whipsaws. I mean, your people, your trading stop losses or your investment losses might get triggered either direction, so to say, because there'll be a lot of whipsawing. I think that's the point that Vaibhav is trying to make. What's the biggest risk factor for India currently, Vaibhav? Is it this rising cases and the way we are managing this, or do you reckon the markets might look at something else, which might happen over a period of 6 months? Economic growth, rising uh, rising interest rates in the world, and that might impact India. What is the biggest risk factor according to you currently?
No, of course, in the immediate short term is what we are seeing the risk factors actually playing out. But in the medium term, rapid rise in inflation along with the prospective rise in interest rates. Having said that, when I talk about medium term, I don't see an immediate, anywhere close to 6 to 12 months, rise of interest rates. Because looking at the second wave which has come about, I'm sure that RBI would remain dovish, and the monetary policy would be, accommodative for a elongated period of time with liquidity being ample in the market. From a global perspective, yes, as things kind of or growth rapidly picks up, then we may see inflation numbers higher. Yes, Fed has guided for a 23 calendar year interest rates hike, but market will keep on chattering about it. But that's a good problem to have rather than a bad problem, honestly, purely because I would rather have some amount of inflation there on the backdrop that economies are recovering, and corporate earnings would be back in terms of the growth.
Okay. Now, Vaibhav, can we split the next piece of the conversation into two parts? One is pockets where you believe opportunities could emerge once the dust settles down around COVID. I mean, the inflation argument is probably imponderable because, I mean, yes, you can pontificate over it, but we don't know when it will happen. But let's work with an assumption that the hypothesis is that in the next few months, the cases would settle. So I would first want you to tell us, where is it that you see potential opportunities where, because of this lockdown, etc., there could be corrections, and once the dust settles, those are the pockets where you believe that the slightly medium term earnings trajectory and the valuations would give you a comfort? What are those opportunities?
Sure, of course. I think the way banking and finance pack has kind of performed in terms of the underperformance in the last 2 months, there is good amount of value there. And as things kind of stabilize, I think growth is just a matter of time when growth resumes back on those names. Along with that, I think industrials is something which we are pretty positive on as well. Or probably, as a matter of fact, any economy facing stock, is something which sectors or stock is something which we would be bullish on. The only aspect where we are getting little underwhelmed is basically that this time around the infections is kind of spreading into rural areas as well, as compared to last time when the rural areas were kind of pretty robust in terms of spending, and the economy kind of stabilized purely because of the rural side. This time around, if it is spreading in those areas, you may see short-term dampening effect on the rural side, and that is something one needs to kind of be aware of or be a little cautious about. So those are the kind of opportunities we are looking from the fund perspective.
But I'm guessing that all of these are not current opportunities. I mean, industrials or economy facing is only once the dust around COVID settles down, right?
Only, yes, only after the cases plateau. Now, it is. I'm not saying that the cases start reducing. Once the cases start to kind of plateau, and we've seen lockdowns kind of already in place, is when you will start to look, from a market angle or from an investor angle, that what further worse can happen to the situation. Things can only improve from here, and is when you will probably start to look to chip in into the markets, and those are the sectors at that point in time when they would be available at some good distressed valuations. Not that they are not good valuations now, but there is a chance that we might get a further good valuation there.
So the frontline banks, Weber, you would buy them not necessarily now, even though the value in some of those might be pretty evident right now. You might just wait for the technical trigger of the plateauing to happen before you go out.
So the way to look out is basically, now if your investment horizon is probably trading, then I would rather time for that. But if my investment horizon is for say 2 to 3 years, I think the current levels are pretty good to kind of keep on investing in that kind of space.
Okay, got it. Yeah, and I thanks for making that distinction. I know you guys probably invest, but I presume you are a long short fund, and therefore you might be taking some tactical calls as well.
Of course.
Okay. Web, the other question is, yesterday, or rather, we had a conversation with an expert who was talking about how FMCG is under a spot. One of the reasons was what you alluded to, that rural has pain, and if rural has pain, then typically even staples tend to have a problem, because if income gets shattered there, then maybe down trading, etc. happens. To the formation of this whole organized retail, and we did a story, my colleague Charlene put out this story about what Geo is doing, and that might have an impact on the existing brands, because white label goods might be out there from Geomart or some of the others. But that notwithstanding, the bargaining power of the FMCG giants versus the organized retail, or versus what they had within the mom and pop stores, is drastically different, and therefore over the course of the next 2 or 3 years we might see gradual margin impact happening. Do you believe that this two-pronged thing, the current thing about rural stress and then this organized retail gaining more and more prominence, might have a dampening factor on the valuations of some of the FMCG staple companies?
See, I think that's a larger question to kind of address, but let's analyze a few variables out there. One, as you rightly mentioned, the organized retail getting into force. My sense there is basically that uh, good organized retail models will take into account the mom and pop shops as well, and yeah, because there is already an infrastructure which is lying. So companies would be able to leverage that existing infrastructure, would have to spend far less in terms of establishing their own infrastructure and penetrating deep. So we will have to wait how it kind of evolves. But till the time the FMCG companies keep on generating the ROEs, which are there currently, without also kind of affecting the future prospects, saying that it's not going to deteriorate rapidly, then we might see FMCG kind of continue to trade at an elevated valuations. Having said that, when we start seeing the resumption of business as usual, from an investor standpoint of view, and not from a business manager standpoint of view, you might see relative better opportunities to be invested into other sectors and stocks, which as I said is probably economy facing stocks, and thereby you might see some amount of money flow out from kind of staples to the other sectors, and you may see some amount of either time correction or valuation compression happening for some period of time. So markets kind of keep on working in cycles, and whenever there is a risk on trade, you see FMCGs in the defensive kind of take a back seat, and whenever economy has risks which are there, then you might again see those kind of coming preferably back into flavor. But in any case, I think from a medium term perspective, monsoons may be good as kind of projected. But as I said, this is an important variable. We have to wait and see in terms of how quickly we get stabilized after this COVID second wave. And that is that I would probably wait there, for more evidence, for more data.
Okay. Vaibhav, my final question. We spoke about opportunities that could come later on. What about current opportunities? While the market is looking slightly precariously placed, are there still options that you continue to stay invested in or might add as well, despite the uncertainties, just because the earnings trajectory or the longevity of growth is looking very, very strong?
Of course, there are a few kind of opportunities. One, global-facing sectors and global-facing companies, including tactical bets on commodities, is something where you are going to see some good improvement into earnings, and earning. In fact, earning upgrades are happening as we speak, right? So that is a pocket where you will see some good interest. At the same time, all the enthusiasm or excitement around the pharmaceutical companies on back of vaccinations, increased medication around COVID, is something again which from a tactical standpoint is something which the investors will keep on preferring. So those are the opportunities one may kind of look into. And of course, if there is a distress valuation happening or available into banking, we may see to do some amount of bargain buying, at cheap valuations.
We'll leave it at that, Vaibhav. Thank you so much for your time today and stay safe.
Thanks, Niraj, and wish all the viewers as well to stay safe and mask up.
Mask up indeed. Thanks for that, Vaibhav, and viewers. Thanks for tuning into this edition of The Talking Point.